continue.
It is a great pleasure to be back in Southwest LA, and I would like to thank the University of Southern California for inviting me to speak to you today. My country is often referred to as the weakest link in the euro area. For some, a failure of Greece could be seen as a failure of Europe. For others, the Eurozone is as only strong as its weakest member. My intervention will be structured in just two sections, given time constraints. The first section will present the main lessons from the Euro debt crisis, Euro government debt crisis, which originated in Greece in May 2010. Given the theme of the summit, I'll classify these lessons in three groups: macro, political, and accounting. The second section looks briefly into the current state of play of macroeconomic policy, and I look also in what more Europe needs for a sustainable monetary union with social cohesion, jobs and growth, and for its improvement in the international standing in the new world economic order consisting of three poles: America, Europe, and Asia. So turning now to the lessons of the euro debt crisis, it is true that when the global financial crisis hit in 2008, Europe was to a large extent unprepared and agnostic. The Eurozone did not have the safety valves and institutions to respond timely to the severe crisis ahead, so it had to buy time. The US proved to be a bit more knowledgeable and ready in its response to the crisis, both at the Fed level and at the government level. Just to recall that the ECB, at the early stages of the crisis in 2008, had even raised its base interest rate. Europeans continued to be sluggish in their response, even after the Greek debt crisis broke out in the first months of 2010. They were continuously behind the curve. I analyze below the lessons of the Eurozone debt crisis from the following three perspectives: the macro, political, and accounting. Before that, a saying from Shakespeare's Hamlet, because this is for Paul, this is for Paul. That was virtue times Paul. So, let me start with the macro perspectives of the euro debt crisis. Since the introduction of the single currency, both EU officials and markets kept a wrong sense of safety as they failed to recognize that the elimination of exchange rate risk would lead to another systemic risk, that one coming from fiscal deficits and public debt. So the focus had turned from the current account deficit to the fiscal deficit and public debt evolution. The key point here is that as a result of the above, euro-denominated debt of a country, public debt of a country, would to a large extent be equal to an external debt. Although your currency is euro, effectively this is external debt because you can't print money. On the other hand, the euro crisis highlighted the vicious circle between banks and sovereigns. In order to cut this Gordian knot, the EU swiftly decided to establish a European banking union among euro member states. So we've got the single supervisory mechanism, in effect since 2014. We've got the single resolution mechanism, in effect since last January. And hopefully sooner than later we are going to have the European Deposit Guarantee Scheme, so to have a full and complete banking union. I finish with the macro perspectives with the following remark. The experience of the last 6 years from adjusted programs in the Euro periphery, and more particularly my country, has shown that there are big benefits from a swift implementation of reforms and privatization. On the other hand, it has also shown that there are limits to persistent austerity and to the disarming of automatic stabilizers when a recession goes out of control. because this creates a second vicious circle of negative expectations, recession, new measures of austerity. Undeniably, less attention has been paid to the role of recession in adjusted programs in the Eurozone, from which a growth element is missing. Briefly, on the political dimension of the crisis, again the focus is in Greece. The huge rise in unemployment due to the free fall in output and dramatic fall in the living of standards and valuations of assets, both real and financial, are disintegrating Greek society and give rise to political and social instability. This in turn gives rise to populist parties with Euroscepticism credentials, which undermines the European direction of the country with potential destabilizing effects even for the euro itself. I'm going to spend now a bit more time on the accounting dimension perspective. This has two important technical features. We know today, after 6 years, that balance sheets do matter in a debt crisis. Secondly, transparency and accountability in budget reporting boost private sector confidence. Let me elaborate on this. Balance sheets, either on the fiscal frontier or the monetary one, do matter in a government debt crisis. For instance, on the fiscal frontier, it is one thing if the public debt to GDP ratio is 40% or if it is 140%. In the first case, you can rather easily, other things being equal, access the capital markets. In the second case, more difficult, perhaps not impossible, but clearly you pay a huge risk premium. However, what is equally important are the following two related issues. Firstly, who owns the public debt? It makes a difference if it is domestic residents, foreigners, the central bank of the country, etc. And secondly, how you measure public debt in terms of future value or present value, in terms of gross value or in net value. Let me analyze a little bit more the above technical but crucial points. After all, I'm here with my professorial hat. On the first point, who owns government debt? A couple of remarks. Japan's debt to GDP ratio was over 200% in 2010. Greece's, the same time, was 120 at the onset of the crisis, But the consequences have been much more grave in Greece than in Japan. Who owns the debt? Here is the crucial point. In other words, what is the distribution of creditors? Most of Japan bondholders are nationals. Most Greek bondholders, we've heard this yesterday also, were foreign banks, at least in 2010, at the onset of the crisis. The point is a simple one, but fundamental. A crisis of confidence comes much sooner if public debt is mainly owned by foreigners. To go one step further, it makes a difference if a large part of debt is held by domestic and or foreign commercial banks or by the central bank of the country. To give you an example from the United Kingdom, which I know quite well, I lived there, I worked as a university professor throughout the 1990s. The Bank of England, due to its unconventional monetary policy and its QE program, holds a large amount of British government debt. In 2007, before the global financial crisis, the UK debt to GDP ratio was 40%, and today is more than 90% of GDP. From this, the Bank of England holds more than 24% of GDP. In that respect, some analysts claim that if we discount properly this debt held by the Bank of England, in other words, to take into account the principal and the interest paid for the years to come, the UK's debt to GDP ratio should be rather 63% and not 92+%. In other words, 30 percentage points lower than the official reported one. In Japan, the relevant figures are the following. Mr. Kurada, the governor of the Bank of Japan, holds about 60% of Japanese debt. 60%. In US dollars, to give you an idea, to get the picture, is $2.5 trillion. In the case of Greece, the Deputy Prime Minister Venizelos mentioned this, the equivalent for us is that more than two-thirds, I think he gave the number 81%, probably is a bit lower, but his point is there, is held by the official sector, which means that this by itself minimizes the default risk. On the second point of measurement, again, a couple of remarks. Future versus present value, gross debt versus net debt. On the first point, clearly, when you try to measure government debt and also do debt sustainability analysis, I was back in 2012 the first economist in Greece to do the sustainability analysis from the government's point of view. Although the program was there for 2 years, was the first one to do. Financial Times, they reported on this, that it's time for Greece to do its homework. So the point is the following. One can't really ignore a low interest compared to the market rate paid for the servicing of debt and focus only on the future value of debt. It makes really a big difference, and also this is in full compliance with international accounting rules. To give you an example, I've heard also another one yesterday from the recent Greek experience. Yesterday was in terms of the ESM loan. I'll give you an example from the first loan, the so-called GLF loan. I remind you that was back in 2010, was about 57 billion euros with less than 2% interest rate and maturities of more than 40 years. In terms of present value, the first loan, according to some calculations, the number in terms of present value is even 1/5. According to other calculations, this is just half. It's not in my position to tell you which is the exact number. This is for you, people in the market, to produce this number. However, it is my position to highlight this point, that if we take into account present value, basically debt is much lower. And of course, I would also like to say that this is a zero-sum game. In other words, what Greece gains, this is at the expense of our lenders. One remark on the gross versus net debt. Here the point is again quite simple. For a full and complete picture of the government's long-run fiscal position, one perhaps should not ignore the other side of the balance sheet, the asset side, and its net growth. We've heard yesterday, the example that if this money, for instance, from the third loan, as indeed is the case, from the ESM loan, goes somewhere, with a handsome return. In our case, this went to the bank recap. There was an element of 5 billion plus, and the return is 8%. It's the infamous caucus here. Clearly, in the future, there will be, some dividends, and this somehow, when you do this debt sustainability analysis, you have to take this into account. Finally, on the transparency and accountability issue of budget reporting as a booster for investor confidence, I would like to point out that after the recent traumatic experience with the Greek statistics, and the game is over, both of them in inverted commas, it is rather imperative for my country to have reliable, internationally accepted statistical data. The bad accounting practices and fishy numbers belong to the past. So full use, for instance, of the IFRS and IPSAS, which is the standard global norm adopted, for instance, by the European Commission, the OECD, the United Nations, and the World Bank, would help towards regaining the foreign investors' confidence. improve credit ratings for the country and companies, stabilize private sector expectations. For me as a macroeconomist by training, this is the important thing, to stabilize private sector expectations. And of course, for politicians next to me, is to deliver job and growth, which should be the ultimate objective. Briefly now, what is next for Europe and for Greece? There are plenty of things there to be done. I highlight that there is a lack of investment in both Europe and in my country. You can see the figure there. Only one number about Europe. In 2015, the investment to GDP ratio was 2.3, less than half the pre-crisis levels, which was 4.8%. In my country, in 27, the investment to GDP ratio was 27%, today is 12%. So we're talking about a huge disinvestment taking place in Greece. If on top of that, we remind ourselves that there is also human capital depreciation, the brain drain that is taking place, plus of course, this lack of money for training, skill shortages, then I called it somewhere else, Greece suffers from a sort of hysteresis, namely the cyclical non-permanent measures accumulated over time become permanent structural problems. If you ask me, Professor, what's the number one problem in Greece? This is the lack of investment, and this is basically the poor, anemic growth dynamics in the years to come. One more word on Europe. Partly as a result of the crisis in the euro area and Europe's relative global decline, the EU is finding it now difficult to manage events even in its own neighborhood. I refer to the migrant crisis. The fog of uncertainty has become thicker on the other side of the little pond due to the migrant crisis and the British referendum. The time has now come for the European Union to take bold action. A plethora of policies and reports have been put forward. I name a few: the European semester, the six-pack, the recently established structural reform support service, the introduction of national co-betterment boards, or even an advisory European fiscal board. These are all fine, nice acronyms, but the European people, they want this be implemented, to be tested in practice. All these initiatives reflect a shift towards more burden sharing. And this is very good news, especially for me as a pro-European. The question, of course, remains how quickly Europe will complete the EMU before it's really too late and move, for instance, towards a common deposit guarantee scheme or some form of sovereign debt mutualization, fiscal transfers, or indeed put in place a capital markets union. Personally, I would like to see the ESM mutated to a truly European monetary fund in charge, among other things, of future debt restructures in Eurozone member countries. There is not much time left. The time has come for change, and I mean the full completion of EMU. There is nothing permanent except change, to quote Heraclitus, a 4th century BC Greek philosopher. As long as Europe adapts, it will survive. There is an old saying in Brussels that the European project only advances in times of crisis, and Europe's leaders have a tried and tested method for coming up with policy fixes only when asked to cope with emergency situations. I'm pretty confident that this generalized crisis would not lead to Europe's unbundling, but will inspire it to introduce long-term changes to the foundations of the European integration project. A very brief digression on the migrant crisis and Brexit, the two hot topics in Europe today, and how these two could be linked. The migrant crisis has triggered a debate about security that may reshape the European Union. Following last month's terrorist attacks at Brussels airport, which have hit the main arteries of the capital of the European Union, its airport and its metro system, we see that the security threat is real if the integration of refugees and immigrants in the Western societies which host them is not successful. There are now mounting concerns and growing skepticism in host countries about the global terrorist threat, the so-called human shields, and how far this could go. For instance, if an attack takes place in the United Kingdom, not necessarily in London, up in Birmingham, wherever, this may well tilt the vote in the British referendum, turning it into a single-issue referendum, that of security and possibly to Brexit. Two shocks of this scale would be unbearable indeed. Coming at a time like this, Brexit could have disastrous effects for the European construction. I close with what Greece needs now. Fragiskos mentioned a few things. I would like also to give you my own insights. I hope we have the completion of the first review yesterday. Then there is a roadmap, clear roadmap, which I will describe it very briefly. From the monetary policy point of view, we are going to have the very same day or even a day before, after the successful Eurogroup meeting, the so-called restatement of the waiver. That will release, this is central bank calculations, at least 5 billion from the ELA that we provide today at an interest rate of 1.5, quite expensive if you think that this collateral will be taken back to Frankfurt and charge zero interest rate, so-called MRO operations. After this will be debt relief negotiations from either of the two options. They are both in the public domain. One is the ESM and the other is the IMF, more aggressive. From my point of view, whatever we take will be good news for Greece. Why? Because then we are going to see some upgrades from rating agencies. We will have the debt sustainability analysis certificate, and that basically will make it easy for Greece to get into Draghi's quantitative program. This last will be the catalyst for spreads and yields on GGBs to go down dramatically. Thank you very much for your attention.